Big tech is rewriting the script this week. NASDAQ just hit a record high with AI semiconductors leading the way, hitting all-time highs, led by NVIDIA breaking out of a year base and breaking out to all-time highs as well. But beneath the surface are other areas in the market starting to lose steam. Or is there enough money in the market for a rising tide to lift all boats? Today, I'll break down the charts and catalysts, exact setups I'm looking at in tech right now. You'll see real trading examples, reading price action, where the smart money is flowing to, specifically at what time. I'll explain why this quarter is make or break for tech and how it could define the rest of 2025. Let's get to it. Hey everybody, welcome back. 27.5% of you that watch these videos do not subscribe. Hit the subscribe button, all notifications, because these videos are linked together. Let's get to it. Now, we all see exactly what's happening with the market here. We all see this monthly close that's setting up. We all see how we're above every area that we're supposed to be. I'm not going to add a lot of value by going look at the market. That's not where we're going with this. What we're going to do is we're going to dive into this. We're going to look at all the pieces that are actually making this happen on a monthly and weekly basis. And what we're going to do is we're going to go broad on the market and then we're going to go deep. I think that this is going to help us really understand the inflows that are going to happen in this market or can happen. And that's really where I want to start. So let's jump right into it. Now, today we're going to dive macro and then we'll go micro. So in other words, we're going to start with the bigger picture and then we're going to go to the smaller picture. And I think that's going to help us really elevate where we are right now. Because a lot of times people can't see the forest through the trees. And the good thing about right now is we have that end of month or end of really the end of the quarter level that we can really look at and see. But we're going to start here. And I'd rather do this on a daily, even though to me it's significant what happened on Friday. If we take a look here on Friday, we can see this 5109. And I'm going to just shrink these down for a second and focus on this one because this is your 200-day. Now, your 200-day this is stocks that are above their 200-day moving average on a percentage that are in the S&P. We all know that the S&P is heavily weighted in tech. I believe right now it's 32.3, or let's just call it 33%. And you can look at the holdings yourself on that. Here's what's happening. You've been in this range forever. And the question is, are you going to break out of this range or are you not? What we don't want is we don't want a divergence where we're losing the 200-day moving average and then at the same time the market's moving up. You don't want that. You don't want that to happen because if that happens, technically speaking, you're losing the breadth of the market. That is not what you're getting. You're getting a significant close over that level, which is pretty interesting to people considering how they traded on Friday or thought about Friday's market. A lot of people were like, wow, things are coming in. No, what we're doing, and we're doing it well, is we're rotating, but the volatility is increasing, which is actually not a bad thing from a trading perspective, but from an investing standpoint, to get in your initial positions, people are finding it frustrating. And I think a lot of that has to do with some of these other levels. This is the 50, and you can see that you were up here at 78, you're at that 71 level. So even though you're here, you have a percentage of stocks, let's just call it 10% less from 78 to 71 that are above their 50-day moving average. Is this important? It needs to be monitored. But the most important thing is you could stay up here forever or in this range forever. What I would say is that what people need to take from this and say, well, what does this really mean? This is where I think you should go with it. I think you should look at it and say to yourself, all right, well, we were up here and this was that area that was so important that we just couldn't break out of. And then when we got up to those highs, and we did it here as well, we would have to argue that this level is 58%. We would see that. And so what we would say with that is, well, when we were up here, 58% of stocks were above their 50-day moving average. And now we would say, well, since you've been up here, we can include this or let's not include that and say that, well, now 71% of stocks are above their 50-day moving average. And we are at the same level, actually above it, of course, than we once were. So is the breadth of the market stronger now? Or is the breadth of the market stronger here? Why is this important? Because you have a lot of people out there right now saying, look, this can't sustain, the market's weak, the institutions are doing that. These are the same people that became war experts, that were tariff experts in April. So it's up to you to just look at objective information and say, what's going on, man? Like, what's really going on? And this is what's going on. The breadth of the market in relation to the 50-day is actually stronger now than it was previously in January. These are facts. They are irrefutable. And that's why I really like the stool and referring to the stool a lot, because you could just look at it and go, okay, well, what's really going on? Your 20-day moving average obviously was a little higher, and then you are right here. Now, I'll tell you why this is interesting to me, because you're flipping the 50 and you haven't flipped the 20 yet on the other names. Now, why people may look at this and say, well, that's bad that we're not there yet. I look at it, and to me, it tells me that we have a long way that we could go, because you're not even over, all these names aren't even over their 20-day moving average. If you look over the 20, which is more of a mild indicator, meaning let's call it a mid versus a longer term bull kind of indicator, because we break the 20 more times than we're going to break what, the 50 or the 200. It just makes sense because it's a smaller indicator, right? Moving averages are indicators where you are in relation to them. So when you have something like this, it's actually setting up, I'm not going to draw a DTL on it, but if you set up like this, you're actually setting up for, as these names go higher or stay here and the 20 curls up, that's actually telling you that, hey, we're rotating and more of these names are going to go higher. On the short-term side, we're hitting these levels and then we're backing off and hitting these levels and backing off. What we really want to see optimally is anything that breaks us down here. That's really where you want to be on those lower levels, and that's on the 5. But I don't think we really have to worry about that. What I would say to you is looking at the 50 and where we are is significant. Understanding that you're not even fully out there on the 20 yet gives you a ton of room to move higher on this market. Whether people want to believe that or not, it's objectively true. And then you would look here and say, okay, well, we just flipped on the 51%. Are we going to push higher? And of course, the answer to this is nobody knows. But you have a lot of things that are going for you right now. Now, in front of you is jobless claims. And this is the thing that if someone said, what concerns you, it would be jobless claim. And why? Because if we start losing jobs, more and more jobs, and we look at continuing claims, which are actually breaking out, meaning if you lose your job, which a lot of people are not losing their job, but if you do, it is harder to find and replace that job. What I would say in looking at that is this. Number one, you're in this trading range of it, where you're at that 261 to 192. You're not breaking out and you're not breaking below it. So what you're taking away from this as an investor or a trader is anything above 262 you would look at on the initial jobless claims and say, I need to start paying attention to this. We're breaking out. And I do see the trajectory, and that is important. What I tend to do with these is I want to look at where we were before and where we are now and see if we can find anything in relation. Now, obviously we had the pandemic where everybody was, laid off. But if you go to 19, you'll see this as well. You can see that we were in this range for a very long period of time once we dropped into it. And that's coming off when we had these spikes in 09 and just worked this down. We're going to get into why I'm so focused on this right now, because I do think it's important. You dropped like this in 94 and you came all the way down to when? April and March 2000, which was your what? That is the peak of .com. And then from there, it exploded to the upside. So for those of you that are looking at this and saying to yourself, I think that this is .com and we are going to explode to the upside on claims. If you see that, that is your indication. This goes all the way back to the 60s. If you see that and you start exploding and losing jobs and they start cutting rates due to the explosion of job loss, then you have to assume that there's probably a top in the market. And what I would do with that is I would chart this. We used to watch this back in the day. We used to watch this religiously every Thursday. We would just watch this number, wait for it to come out. And this is really the only thing that we watched. And what I'm getting at here is if you're in the camp of, hey, I think we're going a lot lower, hey, I think the market's going to roll over, your canary in the coal mine is breaking above 262 on the claims. And I think that this would be actually a better time to roll into Fed funds so that people get it. A lot of people look at Fed funds and don't understand this is how banks borrow, this is how you get mortgages, and why this guy, Itchy is literally the most important person in the world. He actually controls the largest economy in the world by what he does. Personally, I think it should be automated. They should be doing it in basis points, but we could do a whole video on that. What I would say to you is when you're at this level in 06, and you're coming across again, here you are in 86, 92, 91. Look at the level that Fed funds is at. Well, Fed funds is at the same level that you were at before. So where am I going with this? Well, what happened to Fed funds? And this is what we don't want to have happen. I'll be really clear about that. I want them to cut rates when cutting rates makes sense. I don't want them to cut rates, and they did some cutting in here, and it doesn't look like a lot, but they did some cutting in here during 98, during 95. What you don't want is what you had in 01, which was just outright, we have to cut and cut and cut. And why? The explosion of jobs, right? You had all those claims, rather, the explosion of claims. That's a problem. And so what we want to understand here is, yeah, 1 or 2 cuts, that's great, because with increased productivity, it takes us in that perfect spot where we already are in that perfect spot. What we don't want to see is we have to cut next month, we have to cut next quarter, we have to an emergency cut. That kind of stuff, that leads to just ruin. So it's always important when you're looking at this stuff. I'm not here to tell you what is going to happen, because nobody knows what's going to happen. You don't even know what you're going to have for lunch on Tuesday. So the idea of this is to get a snapshot of what would go wrong, and then what we would utilize if it went wrong, and then how we would profit from it. That's what you're doing here, and you're assigning probabilities to it. My biggest concern in looking at any of this is that the continuing claims continue to rise. And if the continuing claims, which are 3.5-year highs, if they continue to rise, what's going to happen when jobless claims start creeping up? That in and of itself is a problem. And this is all tariff related, and we're not going to spend a lot of time on that because I want to really focus on the charts because there's a lot going on here. But understand where you're going to see a real problem going forward. And I think this is super important. As with any investment or any trade, you always look at it not only from a stock perspective, but if it's an investment, you have to look at it and say, where am I wrong? Like what's wrong on my thesis? And then if that happens, then you would understand like, oh, I'm wrong. Hey, this is going to be a problem. And then you can make adjustments. Now, in front of you is something that I use monthly. And I'll be real clear about this. I run monthly scans. I don't look at this daily. I literally will look at this monthly. And I think it's a really good time to run this right now and take a look at what's going on, because I think there's a lot of confusion. Below is PPO. And we're going to walk you through in a second what it is, but because I think it's very important. But I do think that when you look at where these crosses are on PPO, it's a momentum indicator. And you just kind of look at where the crosses happen. Oh, we broke the 0 line. We started lifting up. Okay, this marks that long-term trend. Oh, we broke it here. That marks where we are. We drop back down. And what you're using this for is a long-term indicator. You're not using this to determine what you're going to do in the week, but you're doing it and saying, what are we dealing with and what exactly is happening? And it's important to get this because when you really look at it, okay, well, we flipped here and then we rallied and then we broke down here in February and then we rallied. The important thing about this is I'm looking at a monthly chart. So please understand that with what I'm about to say. That's the perspective that you should look at this from. What I would take from it are these movements on where you're flipping and what has transpired since it flips. And from there, I think there's value in it. Very similar to how I would look at the McClellan summation. But this is really to telling you the momentum. And I want to take a quick snapshot and say, okay, well, what's going on with the momentum of the NASDAQ on a monthly basis? And before we go any further, what's in front of you is just what is PPO. And I ripped this right from Investopedia, which anybody can go to if they ever want to know what an indicator is. I have no relationship to them. Percentage price index, technical momentum indicator that shows the relationship between two moving averages in percentage terms are a 26 and a 12. The PPO is used to compare asset performance and volatility, spot divergence that could lead to price reversals, and generate trade signals and help confirm trend direction. So how do I use it? It's not really about a reversal for me. It's not trade signals for me. And if you're using it for that, that's great. You should do what you're comfortable with. I'm looking for direction of trend. That's really what I'm using it for. Does this tell me which way the trend is going? Now, when I look at something like this is the equation for those people that like, how are you calculating it? Here you go. Here's the calculation. And what we'd want to do here is super simple. We just want to look at this and go, is this something that we should be paying attention to? Well, yeah, it is something that we should be paying attention to. Here's where we cracked on the monthly chart, and that was definitely something that marked the top of the market. Here is where we flipped, and obviously the bottom was in whether or not you believed it. And you can see that the indications of this over and over again. Once again, you can see it here in 16, you can see the roll here. Once again, you are in what? A monthly chart. So please understand and take this with a grain of salt. I'm not looking to trade off of it. I'm looking for a trend indicator. Huge difference. I'm not saying when it happens that you go out there and say, oh, I should short, because this is rolling over and then you're getting this. What we would have to do is just look at it for what it is. We can all see the support and resistance lines and everything else here. But what we'd really want to focus on is here's where you flipped and you went higher. And now what's happening here, and it's unequivocal, is that you are above your zero line. You hit your zero line. You rallied from your zero line. You broke it here, and it's telling you that you're going to have a trend once this crosses, unless it touches and does not cross. But it's telling you that you're setting up to cross again and that the trend is going higher. What this is a monthly chart. So when I look at this and people say to me, oh, we can't possibly go any higher, this is it, I always go back and look at things along the lines of going, okay, well, what was the highest indicator that this thing ever had? Okay, well, that is substantially higher back here in .com than where we are. I always look at that, and I always want to look at the lowest levels. It doesn't mean you're getting there again, but it just shows you what happened during that period of time. So I would look at this and go, well, I'm definitely not at the highest level that we've had in 25 years, so that's pretty interesting. And then I would look at this and go, well, what else is this telling me? Well, it's telling me that when we cross, we tend to put in the trend that is telling us that we're going higher. It's not telling me that I need to buy now. It is telling me that the trend is up. So that's all I'm looking for. Is the trend up or is the trend down? And if we use it for that, I think we'd be very happy using it for that tool. Is the trend up? Yes. Fine. Is the trend down? Yes. It's pretty much nailing it over and over again. Now, if we cross again to the upside, that would tell you confirmation that you now have a uptrend. And then we would constantly monitor that, which I do every month. I have a whole list of names that I run, and I run a scan every single month to see what's really going on globally and with oscillators that look at momentum and breadth, things like that. I should actually publish it so that you guys can run it for yourselves. But we're going to go through a couple more of them right now. This is significant to me, and I do watch this very closely on a monthly basis. Now, what is leading? We always want growth to lead. We don't want value to lead. We always want growth to lead, not value. When value leads, we're being defensive with our money. When growth leads, we're being aggressive with our money. And this all boils down to the same things that we've constantly been talking about here, which is the macro side, right? We always want to know, what's the Fed doing? What are they thinking? Well, we know that they're talking about cutting rates now more than ever. Now, whether that is circumstantial, whether that is because they want the job in May, that remains to be seen. And that's going to tie us directly to what's going to happen with certain sectors, which we're going to get to. But then you have the fundamental side of the market. And that's always, how are earnings affected by what they're doing macroly? So we always look at it and go, well, who's going to be affected, right? Because that's going to affect the fundamentals. But then it boils down to what. So you have the what, the who, and then of course, as always, we have the when, which is what the technicals tell us, right? What is macro, who is fundamental, and then when do we act on that? And understanding that is so significant. And it's why, honestly, it's why I love the community, because when you talk to these people and they're saying whether or not this is short selling or whether or not this is, this guy's doing this or this guy's doing that, I always just tell people to go back and just refer to it. Just because the macro is strong doesn't mean technically your stock's going to hold. Just because the fundamentals are strong with your company doesn't mean the technicals are going to hold. Understanding that is just an absolute game changer to people. And you can buy the same company for $87 that you can pay for $150 just because you understand technical analysis and the macro really didn't change. But the perception changed, right? That's when we get into all that reflexivity that I go over. I should link that video at some point. But I do think that this is really very important for people to get, because you look at this and go, well, who cares? Well, you should care, because the only time that you're buying growth versus buying value, and the only time that this is ever lifting, is when the macro side, you're not buying growth if the macro side's not strong, because the macro side's going to be strong. And if the macro side's strong, it means that fundamentals and earnings are going to be strong. And that's why everyone says, oh, well, I only care about earnings. Well, that's great. You only care about why the dog's wagging their tail. You're not looking at the treat that's in front of the dog. So you want to understand why the dog's wagging their tail and why the dog's excited, right? And this is why. It's always what's in front of its face. And that's the macro. That's why it always boils down to that. And that's why the market always moves the way that it does on the macro. So as always, life comes back to the stool. But if we look at value versus growth here, let's take that off. But if we look at value versus growth here, you would see very simple patterns, right? Up, down, 1, 2, 3, up. Those rising 3, falling 3 patterns are pretty much bottoms. And now they're setting us up to rally. There's no real pattern here that's more predictive than something like this. Just very clearly, it's like when you see 3 black crows at the top of a chart. When these technical patterns that you see, you can use them anywhere for anything. And I think that's very important. People forget that. They look at them not on a relative basis, but they'll just look at them on a stock chart. I see a breakout. I see a gap and a breakout where they are buying growth. And growth versus value is now at an all-time high. If we did the simplest things and just drop it to a line, you would look at that line and someone would say, well, where is that going? You would say, well, that's going higher. It's very clear how you would look at that. Even if you drop it on the weekly, you would see this base that you've been in, you would see the undercut, and then you would see that you're setting up to break out. They're buying growth. They're continuing to buy growth, and they're buying growth to the point that growth is actually breaking out on a growth versus value level. Now, of course, we have a couple days left before the end here, but I do want to just point out some things that I think are really interesting here, and I think that people should think, well, hopefully they find them interesting. But here's the ITB, and that's the home construction. And I can look at the other side of this too, which would be XHB, and we can just go take a look at that very quickly. But what I'm really looking at here, and you can just see it's a little more wacky, but this is just going to be home builders. And what ITB also includes is the construction side of the market. So not only the home builders, but also the construction side. And I think that that's just going to give us a better understanding of what's happening. And again, we have our reversal up here. Everyone can see this bearish engulfing and pretty clear what's happening right here. We peaked and everyone's, panicked, with the market, and then the transference of power. We're going to have inflation, whatever. And then, rates really don't go anywhere. But here we are, and we're dropping, and then we try to lift and have our first higher high, but we have no follow through. We get a doji, the doji undercuts here, and we continue to trend down until we find some level of possible support. So now we have this bar where we do the undercut and then the sideways lift and the failure and the undercut here as well, and now we're holding sideways. Why is this important? It's important because it's telling you that we're probably going to see an environment here where they're going to cut rates and they're getting ahead of it. And this actually does make sense if you think about who's going to come into power. When we see who's coming into power, you're going to get a new person in May 2026 that is going to be a new Fed chair. They are going to be dovish. If you don't think that, I would watch the news. And I don't tell people to watch the news, but it's very clear what they want. It's very clear what this administration wants. They want rates lower, to the point where he's holding meetings a year out or 10 months out before this guy's even gone, just to kind of say, hey, this is where rates are going, so get ahead of it. You don't have to worry about this guy, whether he's going to cut or not. This is all leading you to the fact that they're certainly not raising rates. No one's talking about raising rates, which means that they already know that they're not worried about if inflation creeps up a little bit or not, which is kind of interesting if you read what they're telling you. But what is ITB telling you? Well, ITB is telling you, hey, we might be done going down. We don't know yet, but we're getting to that point where, hey, if we hold in here and then we start flipping higher, we make a higher high on a green bar, which we haven't had many of this year. Matter of fact, you've only had one other month where ITB has been green. Hey, we're starting to get to that point. And we'll look at some of these names later in this video. We'll get specific, but this is telling us something. And it's something that we have to pay attention to. And I would not sleep on things like this. Now, if we drop this down on the weekly and we take that monthly apart, remember, when you look at a monthly bar, it's 4 weeks. 1, 2, 3, 4. 1, 2, 3, 4, 1, 2, 3, 4. It looks very, very different than when you're looking at the monthly. And we can just look at the RSI for a second and say, well, we bottomed here and now we are starting to try to lift. Whether we do or not remains to be seen, but you are holding this level. And I think that that's significant. If we do the simplest things and just drop in a 200-week moving average, we can see that we've hit that moving average and that we've been basing above it. And quite frankly, since April 7th, we've never taken out that low, but we also have never broken out. So really, what do we want to see here? Well, I would want to see, let's put this magnet on so it marks it perfectly. I'd want to see a breakout and a weekly close at a minimum above this level. But some of these names, and we'll get into it today, some of these names look like they're finally setting up and they're finally ready for that big move. And I do think that this is something we should be looking at. And it also talks about the health of what we're seeing in the market, which is really what I wanted to cover. If you don't have a strong housing market, and our housing market's been very weak, but if you don't have a strong housing market, you don't have a strong consumer, right? Because the stabilization, you want that stability of where you're living. And I think that's very important for people to get. And when I look at something like this, yes, this is important. Watch ITB, and I would watch from a trading perspective anything over 97.62, which could lead to a rally in names that are completely beaten down. Where do we go through some of these names and you see how cheap they are historically? From a perspective of looking at the dollar, which I think we should do before we get into what's going on in Europe and where I think this is heading. If we really take a look here over the past 40 years, or so, and we just take a look, you're going to note that you really haven't gone anywhere. You're up, you're down, but there are some things here where I think that it does point some things out, where if I go back to this period in the 90s, that's in here. Over, under, rips. Okay. Drops down. All right. We're more global than ever before. People don't realize that that stocks that were actually dropping were dropping because Norwegian banks are parking, money into NVIDIA to use it to hold their currency. Like people didn't understand that in April when the market fell apart. So it really was the driving force. So what we would do is look at this and say, well, since January, we've been on a decline, hands down. And we are, and it could go lower. As a matter of fact, if you were to look at this and you were a betting person, which I am, and someone said up or down, you'd have to say down. Like it's a no-brainer which way you'd have to lean, right? That's how I view it anyway. So what is happening here is pretty interesting, but I want to point this out before I went any further. And of course, we have that time frame that I like referring to, which is that 95, 96, 97. And then we could look at what really set that off. Well, what really made us rise was when .com exploded and everybody globally had to buy U.S. companies. They had to buy dollars. You don't really have to do that as much anymore with all the different intricacies and all the different synthetics that are created. But I would say this, if you start to see the dollar rise, I think it means that they're going to start buying way more U.S. stocks. What I'm seeing already is I'm already seeing them starting to rotate back into the U.S. market. And I'll show you what I mean by this in a second. But they're already rotating back in. And that doesn't mean that the U.S. can't, or that Europe can't go higher and the DAX can't go higher and European defense names can't go higher. They are going to go higher. They're going to go through a boom. When you look at something like this, it does tell you what you need to pay attention to. It really does. Like if you start seeing the dollar just start going very aggressive, it means that you're probably on a monthly basis, you're going to want to watch to see if that reversal ever happens and then get out of the way. That's definitely something. And you can even see it here from August, September on, and you'd see where you peaked versus where you are. I mean, it's very clear. For our purposes, what I think is very important for us to take from this chart is the fact that you can go down on the dollar all the way to 80 and you're actually in the mid-90s before the .com. So does it matter to tech stocks that this is falling apart? No, it really doesn't. Once it starts and they understand it, it really doesn't. What matters is the allocation of funds based upon the dollar. So if the allocation of funds has already taken place because of this drop, then if it continues to drop, it doesn't really matter anymore because of the allocation. And you're at one of the lowest allocations that you've had in U.S. stocks probably in the past couple decades. I'm not going to get into that because it would be opening up a can of worms, but I can do it in another video. I do think it's very important to understand where the dollar is and that initial outflow has happened because of it. I don't think that if you continue to drop here that you're going to see the same movement, and I'll show you why. In front of you is EZU versus the SPY, and it doesn't matter which one you really use, but this one just makes sense. And what we're looking at here on a weekly basis, and we can drop this to obviously a monthly as well and start there and then drill into it. But you can see that it's just, Europe versus the S&P. It's just an absolute mess, right? EZU, you have these periods of rallying and then you roll over. And now if we just took this on a monthly standpoint and drilled into it, well, anybody would look at this and go, well, we came to the top of this control bar where Europe was rallying, and then we have that break in Europe, which was June of 24, sold all the way down, and we have a doji, and now we've broken that doji, and that is a reversal or a rejection of that level. Anybody would look at that and just look at it from that perspective and say that's what you're dealing with. Drop it to the weekly, and it gets a little cleaner, doesn't it? Where you're watching this level and you're looking at these somewhat battle areas, or you can even use the top of this gap that happened in 22 on the gap down and see how you were rejected there, rejected there, rejected there. So by drilling into this a little bit, we can see exactly what's really happening when we get to that level. Matumbo, broke out. It's definitely going higher. Matumbo, right, over and over and over again. Drop it back to the weekly, and I think it tells us something a little bit even more impressive. And what we're trying to figure out here is not is Europe going higher. That's not what this is telling you. Not is the S&P going higher. What it's telling you is the relationship between Europe and the SPY. You've had a tremendous amount of money, if you look at this on a weekly basis, from January on, since the inauguration, that has just fled. And why has it fled? Well, we know why it's fled the U.S., right? Tariffs. People are scared to death of that. Like it's not going to spread to other places. But if it's going to spread to other places and Germany or Japan is trading at a 9 PE, and the SPY's trading at a 20 PE, well, macro traders are just going to go, well, this is a no-brainer. I'm going to go over here, right? Because they're looking for relativism. They're not looking for absolute. So if we look at this, okay, well, when did that speak on that weekly? Well, that happened right around the tariffs. Well, the tariff pause was here. So Europe actually benefited more from the tariff pause than the SPY did. We were just so focused on our own markets, most people missed it. But we have that peak here. And since then, Europe has just been trading down versus the S&P. And a lot of people, they're not really getting that. Why do you care about this? Because when inflows start coming back from Europe into the US, which frankly is already happening, because if it wasn't happening, this wouldn't be doing this. So you have inflows that are coming back into the US on a relative basis. Again, if it wasn't happening, this would already roll over. And it's happening while the dollar is falling apart. So what happens when the dollar starts going sideways or starts going up? What's going to get the dollar to go up? What's going to get the dollar to go sideways? Your guess is as good as mine. But again, what we're always doing here is we're connecting the dots so that if this happens, then this happens, right? If I'm to clean all this off and look at this, and you're starting to see institutions get way more aggressive than smart money, dumb money is showing. But that would be our, in my opinion, bigger level or bigger DTL. But of course, you have one right here as well. And what I always like about these, and I should really do it this way, what you like to do with these is you really want to clone them to some extent and look at the trajectory and see if the trajectory fits somewhere else, because it's the angle, right? It's the angle that you really want. It almost looks like a fork. Like if you hit it again and you clone it, because that's what you're looking at. You're looking for that angle on what are they doing there? And you can see it here, of course, now, right? So now you can't unsee it. Look at it. Anyway, if you see how this is going, you'll see the level that I really want to pay attention to. And let's clean this off. We're going to need way more coffee this morning. And we're looking at that level and you're like, yeah, I got it. I see what you're talking about, Boomer. Right. We tried to rally and we failed. Got it? Good. All right. What you're going to see next is that level here where you've broken out of, and then you rallied, and then you failed, Matumboed, and you're back and you got Matumboed not once, but two, Matumbo. Now, clean all this off and watch this, right? Here's the RSI on the weekly on the relative basis. You got up here and this is where you failed. You got up here and this is where you failed. So you're actually overbought here and selling down on Europe versus the US, and the same time, while this is going on, the dollar's dropping. This is really important to get that concept, because the money that's going to come back in to the US, if and when the dollar stops falling down, is significant. But you could still get to 80 and still have a really strong market. And that's the part that I'm getting at here. People all of a sudden become dollar experts. Don't do that to yourself. Also, we're going to get into the order flow of institutions, and you can see it really in the last hour of the market, which is something I really try to hammer home. Let's take a look at that, and then we're going to get into some names you have to watch next week. Now, if you've been following this channel for some time, you know I love looking at institutional order flow. This last hour does exactly that. This is not something that I created. This is by Sentiment Trader. I have no affiliation with them. And the area in question that we're really going to be focusing on is right here. It's going to be really what's happening actually since January 2025 over, and kind of this basing of that pattern. What you're going to note about this is that you're basing for a period of time, and then that basing kind of starts leading to rallies. And why? Well, this is a cumulative reading. And I want to say that again, it's cumulative, meaning it's 1 + 1 that gets you there. Now, you can also see periods of accumulation, and they'll be at other levels versus where these are. This is a numbered system, and that number is based upon the accumulation. It's really important to get this concept, because you look at this number and go, oh, this is higher, this is lower. Yes, it matters, but it matters on where that accumulation is happening. And it's very important to get this, because an accumulation up here is more important than an accumulation down here. And why is that? Because it is cumulative. So what I want to do here is I want to show you how this is calculated very quickly. Some people have seen this before, and then we'll talk about what's happening with it right now. Now, some people, when they watch these videos, say things along the lines of, you don't need to explain this stuff, just show us. You need to understand what you're looking at. The last indicator, the last hour indicator, is a cumulative advanced decline line. Cumulative advanced decline line for the last hour of trading on the SPY ETF. So from 3 to 4, 3 to 4. Got it? Good. If the last hour of trading is up, a value of 1, yeah, you get a plus. And the value it added to number. If it's down, the value subtracted from the count, you would get a minus. Cumulative. The trend model applies to a moving average. Advanced decline looks for instances when the count deviates above or below the moving average using a threshold signal. I don't use a moving average. Once a trend occurs, the model buys or sells the ETF, whether it's favorable or unfavorable, and they're showing you how to do that through a moving average. That is not how I use this. I'll show you how I use it. Now, I'm not going to do a 40-year history of this. I'm going to take 5 years, and we can always do it longer time frame at a different time, but we have a lot to get to today. If we look at the last hour over 5 years, we will remember the words that were used earlier, that this is, of course, cumulative. You have a level here, 530. Why is this important? That is a number that is +1, -1, +1, -1 until it got to 530, and then it decides whether or not it's going to upturn or not. If you take a look at your level right here when it got above that 530, 530, and then we look at how we reacted right to that level at 530. Did we put a bottom in the market? The answer is yes, you did. When you broke 530 right here, what happened to the market? Well, eventually we cracked. Is that the reason it cracked? No, but it's showing you that cumulatively at the end of the day that institutions are buying and selling based upon a certain parameter. So when we get above this number, and this is why it's so important for you guys to really understand what the heck you're looking at when you look at these indicators, because then you could say, well, cumulative above 530 seems to be more positive, where accumulation under 530 doesn't seem to do squat. So there's that ball kind of momentum rolling down the hill where institutions kind of have to have their bellies full a little bit for this to actually work. And that demarcation line is 530. You can see how you got to that area, 530, and then from there, what did you do? You actually bounced right off that area. So now that we know that this is the area pre-above 530 or post-below 530, we can see that this does mark a demarcation line that we would want to pay attention to. I also thought it was kind of interesting how you bounced off that, went up, undercut, rallied, and then undercut again, and that marked the high. But for our purposes, we're looking at this and saying, are we seeing institutional accumulation, which is the last hour? And the answer unequivocally is yes, we are. Zooming in on that 3-year, and I do like to do this because I think it's very helpful to just watch this on a more shorter time frame. It just kind of tells us exactly, what same thing that was told us earlier, but it just tells us a little closer. And then you're going to start noticing something here. And it's these little nuances that make all the difference, in my opinion. They just do. But you'll note that you kept hitting here over and over again. Now that is drawn god awful. So we're actually going to draw that again. Give me a second here. We're going to find that eraser and we're going to do this together. Boop. Promised not to make that noise again. Promise broken. So if we click right there again, and then we come across, you'll note that we undercut right there. And then from there, we're just gonna have to rock with that. And then from there, we'll note that we bounced up, down, up. Why is this important? It's cumulative. So for whatever reasons, when they start dribbling out there on their equity holdings, they start buying for whatever reason that is. So then you would kind of come up here and go, oh, what does that put us at? And you see that level right up here on the index. And then you watch what happens to the index right around that level. It's not rocket science. For whatever reason, when they get at that cumulative level where they don't have enough equity exposure, and it's probably more tied to some other stuff as well, obviously the bond market, what's going on there, but that cumulatively is making them buy more. And they are 100% buying more in the last hour. A matter of fact, you could see it unequivocally today. I'll show you in a second here. Here's our 530 line, and just so you can see where I'm going with this, there's that level, and every single time we got to that level, what happened? They bought. So if we came across from that low, from right here, and all I'm doing is taking this point and coming up with it. And then from there, you're going to note that that was the level where there was always accumulation. Doesn't matter where you are in the market, but when we got here on the last hour, they stepped in over and over and over again. And that's very important because it's not about just where you are in the index. It's about where they are on whether or not they're accumulating or not accumulating. And this is putting a bottom in accumulation and telling you where they're going to come into the market. And I think that's really significant. And why are they doing it there? I don't really have an answer to that. I don't understand. I don't know that. It's got to be something else that I just really don't get. But when we draw that across, I would actually argue understanding where you are in the last hour, this level, is more significant through that +1, -1 than even where you are in the index, because this allows us to understand whether or not they're going to break out of this little range or not. And quite frankly, it looks like they are about to break out of it. Now, we're not there yet, clearly, but I think we're getting there. And you're right around that 540 level. Looks like 541, 542. If you mark that off, you can see that you're pretty much there. Roll that up just a little bit there. But that's really your level where you're trying to get to. And if we flip that area right here, you're going higher. And we are seeing this. Watch when I'll go to the 3-month. You can see it a little closer. When we really zoom in on it and we take a look, coming straight across, you could argue that you're there and that you're getting ready to flip it maybe. And we'll watch this. And how would we determine whether or not this is going to happen? I don't know. Let's watch the last hour of the market and see what happens for this week and see from 3 to 4 in the market, do we get that plus coming straight across or do we get a minus? And all we have to do is just watch the last hour. Take a look at this. I think this is pretty significant. Today is Friday at the time recording this. You can see the time right here when I am recording this. And it was interesting. I just got done doing a coaching session with someone I've been coaching a while. And we were talking about the market and whether or not it's institutional buying or is it retail buying or is it short squeezes or is it not short squeezes? And then the question that I asked is, does it matter? If it's institutional buying, does it matter if it's third long buys or short squeezing? Because we don't know how much would be on the short squeeze. But I think it's really important to understand that. Like, don't get lost in between, just staring at one tree when there's a whole freaking forest in front of you. And so here's 9:30. All right, so here's 9:30, and we know that the first half hour we want to watch, and then we get Michigan consumer sentiment today, and that's 10 o'clock. And then from that 10 o'clock level, we start to get a different time frame. But then we know that institutions really don't participate that much then they do at the end of the day. But we all know by 10:30, you get a different market. So you mark off that bar 2, which will be right around here. And you can kind of see from that area over, even in here, that that's pretty much the high. You don't really go much higher than that on the market. And then, of course, we get some, we'll just mark that. Actually, let's just mark the top of that right there. And then we get some tariff news where Canada's like, boo US and your tariffs. And then, on come mean tweets. And then the cycle is complete, right? And here we go again. And this is why I just love the market so much, because it's just so textbook. Look what happens right at 3 o'clock today. Lo and behold, we get a doji, a low is put in, and then we just lift for when? The last hour. It's more important lifting on the last hour on Fridays, because this is really when pension funds and large institutions start clearing out their stuff. They're like, hey, I was supposed to sell 1 million shares of XYZ. I didn't. We got 200 on the books. Make sure you get out of it. Or, hey, we needed to buy 1 million shares of NVIDIA because it's awesome. And we're short 250. Make sure you get 250 of it before Friday, because we need the equity exposure to balance our portfolio out. There was a huge rebalancing in the market today that I will go over with you. One of the people in the community just nailed the thing. What is important about this, and why do you care about this? You got to see the forest through the trees. So when you look at these indicators and you realize that it's the last hour of the day that you need to pay attention to, you want to watch the last hour of the day and say, hey, just mark it. Hey, are we up? Is it a plus or is it a minus? And if you see there, forget the noise and just look at what the market's doing. We could argue, is it short covering? Is it not short covering? Is it long buys only? If it is short covering, do you know how much is left? No, you don't have a clue. So don't put things, trading's hard enough. Don't put things in your mind that you don't need, right? I can't stress this enough. Let me show you this rebalancing, because it was really very impressive. And now you have something that you should be doing all week, looking at the last hour. If this is helpful and this example is helpful and how I broke this down and took that indicator from 5 years to just down to a day to looking at an hour, so you can understand how you can do this for yourself, please comment. I don't mind going through this level of detail. I just want to know that you want this level of detail. Now that that is out of the way, we have to look at where we are and what kind of trader we are. And this is super important for names. So we all know that tokenization is here, stable coins are here, Circle is the company. That doesn't mean that you don't have periods where this thing's going to have massive drawdowns and be able to take advantage of it. One thing that I would like you to leave with today are just some basic tools on how to look at some of this stuff on a shorter term basis. And then I want to get into some names that I do think you need to start paying attention to. But if you look at something like a Circle, the easiest thing for you to do is to drop a peak VWAP on these names. Any name like this that you're thinking about, I want to be long, write this down and get a tattoo of it. If it's not above its peak VWAP, you're renting it. You're not owning it. You need to be above peak VWAP. If not, you're going to have a problem. You don't need to be back at peak, but you need to get over peak VWAP. If you use this, it will keep you out of harm's way. It will actually present opportunities for you to get involved with it. The other thing that you always want to look at when you're doing these trades is how you're acting at key levels. What I always pay attention to are these levels right here, where I have a doji and then it's that low. You always watch how you act at that. And then if you have another one, let me just make sure that this is perfect. And you might want to watch this again. I am going to do more videos on specific trades. I am going to do a video specifically on this, but watch that doji level here and watch how you acted on it. Matumbo hits it, rallies, the retest. You already know what happens here. You already are fully aware of what happens at this level. It rejects. It has yet to prove worthy to hold that level, and you get the gap fill. This presented a huge opportunity for us in the community to short this on Friday. And we knew that we had weakness here because it proved how weak it was, right? Weakness sickens me, but I can still profit from it. So when it does this, we just buy puts, and then you can leave the puts on. Now, what's great about this on a Friday is that those puts have all that theta decay out there. And that's why I really want to get into this in another video so people can understand the best time to do these kinds of trades. But look, take a look at this. even though I believe wholeheartedly in what's going on here. I really believe in what we're seeing here. The most important thing, and I do think this is going to be a monster stock, it doesn't mean that I have to buy it now. We're actually buying puts, and as those puts are dropping, we're trimming into that move down. Our target was 180. Enough, it hit it. It's kind of interesting that we actually said exactly where it was going to go, which is pretty freaking rare. It doesn't usually happen that way, let's be honest. But that's where we thought it would settle. Now, what do you do with the trade now? That's a trade. That's not an investment. Super important to understand the differentiations. When we look at something like this, we would have to say to ourselves, what are we looking for? Now, if I clean off my levels, what you could do is look at the 3, the 5, and the 8. And that's exactly what you're looking at on this chart. You're looking at a 3, a 5, and an 8-day moving average on a 15-minute chart. You can make these for yourself. If you're in the community, you already have it. If you're trying to get in the community, make sure you look. There's a wait list, and make sure you look for an invite because it's coming soon. And then I'm shutting it down for a period of time. Closing enrollment. 130, 78, 208. You can screenshot it for yourself, and that's those levels on a 15-minute chart. Very simple to do. Yellow's on top. Yellow means caution. Green means go. Go, caution, stop. You see where this is going? I need these to flip before I could even consider getting into that name again on anything more than a trade. Really important to get that. The other thing that I want people to understand, even with coin, and I have a very large position in this, it's actually my largest position right now. Surprisingly, I think the other one just might overtake it. We'll get to that one in a minute, but you guys already know what it is. But if you take a look at something like coin, you're holding that 348 level perfectly, which is tying right into that 5-day moving average. You're not really breaking that level. So there's not much to say or to do there except, hey, you are holding that level and you want to watch. But what you need to be careful of here, if we drop to this on a daily, is you did undercut and you did make your first lower low and you did run right into that brick wall that we've been talking about up here for some time. And you can see it right here was that 380 level, and those people said, hey, that's enough. It's actually a little higher. There's a markup here, but we'll leave that one as well for now. But there's another level up there at 380. And the easiest way for us to mark that for you guys is just drop another pin right there and you'll see it. Just pay attention to that level now. And now it's going to be one of those things. Do you form a flag and do you build on that flag? And I think that the answer is yeah, I think you could. I don't know that you're just going to break down here. You're kind of wedged in here. And I think from my perspective, it might be a good thing that you're going sideways. The themes aren't going to change. We'll do another video on the themes very, very shortly. But I do think there's a couple things to really be aware of here. PLTR, this drop was not company specific, but rebalance specific. One of the guys in the room just nailed this. And I did not think that the rebalancing between small and mid cap in the Russell would create this kind of opportunity, but that's why you're down. We were actually able to know this, actually able to pick this thing off end of day at 4 o'clock, and you can see that it just started running. I'd watch this heavily on Monday for you people that want to own it long term, and also the people that want to trade it, because this is going to be a really active trade. Why people are trying to figure out what to do with it. Here's your exact level to watch, 136.11. The other thing you can always do, is drop a VWAP to there and you'll just see the outright destruction that existed. One thing that I wouldn't do it that way. I was thinking I was going to show you how to use Bollinger Bands, but for the time we have, we won't. Just focus on that and focus on that 136.11. I think that's the most important thing that I can tell you there. And finally, when we start talking about ITB, if you and I know, because this all goes down to reflexivity, if you and I know that they are going to cut rates in the future, and we're all watching the 10-year do this, then we know they're going to drop mortgages. And if we know they're going to drop mortgages, then we know people are going to start buying home. Do we look at Toll Brothers? Maybe, but I'm going to tell you something, a scan that you should run for yourself. And you might just want to jot this down. You want to look at book value and cash flow positive. Get a list of all the home builders that are trading under book value. I've been doing this trade for over 20 years. It's literally the simplest trade. Look for names that are actually cash flow positive and trading under book that are home builders. And then you just sit back and you wait. And that's not it. It would have been way better if it went exactly to the one that I wanted, but it didn't do that. And I will leave you with this. You can look at Beazer, you can look at MHO, and then you can look at this other one that I think makes a lot of sense. But these are smaller ones, and people might not want to play those. They might want to look at something else. But I think that the devil's in the details. And what I would be doing is I'd be looking at the book value of some of these names and just having the patience to stay involved. That's it. There's a lot in this one, guys. You might want to watch parts of it again. Have a great weekend.